This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Now let's get to that chart deck. Listeners, you're going to find a download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Rory's picture that says looking for the downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
EIA printed a build of 774,000 barrels this week, Cushing, Oklahoma building 272,000 barrels, gasoline building 65,000 barrels, distillates was the only drawdown on the board at 792,000 barrels, while U.S. production held unchanged at 13.2 million barrels. So needless to say, that big Q3, Q4 massive drawdowns of 20 million barrels a week, well, we actually got a build this week. So it's not happening the way analysts thought it was going to go down this summer, at least not in the EIA data. Israel moved forward with ground operations in Gaza this week and suffered some casualties from Hamas. That could have the potential to escalate the intensity of Israel's ground invasion. Meanwhile, the United Nations warned of rapidly escalating risk of this conflict growing into a broader regional war. Then both Tehran and Moscow made statements warning of the risk of further escalation if Israel escalates its operations. Crude oil sold off by a full $5 on the news as of Wednesday's close. So the message from the market is crystal clear. The market no longer perceives any serious risk of this conflict escalating in a way that could threaten global oil supply. They're not worried about Iran closing or mining the Straits of Hormuz. They're not worried about Iran keeping its promise to escalate to a direct war with Israel if the IDF makes a ground invasion of Gaza, which is already occurring right now. And they're not the slightest bit worried about Senator Lindsey Graham making good on his threat to use military force to destroy Iran's oil-producing and refining assets as retribution for Iran keeping their promise to escalate if the IDF does what it's already doing. So far as I can tell, none of these things are perceived by anyone other than me as a serious upside risk to oil prices. In addition to Dr. Anas Al-Haji and Ola Hansen and now Rory Johnston, who have disagreed with me here on MacroVoices, I had the opportunity this week off the air to discuss my views with two other very highly respected voices in the crude oil market, and they both agreed with our recent guests and disagreed with my view that there's still a very high risk of oil supply threatening escalation in this conflict. They all seem to be confident that Iran would never be stupid enough to risk its very existence by escalating this conflict while the U.S. has 2 aircraft carrier battle groups and several guided missile destroyers and cruisers on station in the region for the purpose of deterrence. Now, to be sure, their view made money in the market this week, and my view lost money. We've now broken briefly below the continuation 100-day moving average on WTI and came within a few ticks of the contract 100-day moving average. And on Wednesday, we retested the October 6th low on WTI. That was the day before the Hamas assault on the rave in Israel. So all the geopolitical risk premium has now retraced completely as the market signals what I think is a remarkable complacency that the risk of this conflict affecting the oil market is pretty much over at this point. In discussing this with one very prominent market expert this week, I heard the first counter-argument that really made me think hard. When he asked me what I'm so worried about, I said I think this conflict is part of a much bigger trend. First, we had the Russia-Ukraine situation threatening the global world order, now Israel-Hamas, and to my thinking, it's only a matter of time before some sort of conflict arises between China and Taiwan. I told him that while I could be persuaded that maybe Iran might be smart enough not to retaliate while the U.S. has half of its military arsenal pointed directly at them, I'm still confident that they won't forget this event and that they'll retaliate in due time, once again risking a U.S.-Iran military conflict that could lead to Iran at least trying to mine the Straits of Hormuz, and if Senator Lindsey Graham gets his wish, that could lead to the United States completely eliminating all Iranian oil supply, which would consume all of global spare capacity, per Rory Johnston's numbers in today's feature interview. The part of his response that caught me off guard and really made me think was when he said that he agreed with me that China-Taiwan is a very serious risk on the future event radar. But then he went on to explain why he saw that as potentially being massively bearish, not bullish oil prices. He explained that China could blockade the global shipping traffic through the South China Sea and literally shut down global trade, which could have the same effect on the global economy as the pandemic had. Now, he also acknowledged the counter-argument that it could also lead everyone to hoard oil, which would be bullish. His real point was that it could go either way, and it would be foolish to assume that geopolitical conflict always equates to higher oil prices. That gave me something to think about while we wait for the next chapter of this fourth turning to unfold. Returning to the present conflict, I still think there's way too much complacency in the system, and I also think that many Western analysts are misinterpreting some aspects of this situation. For example, I heard a couple of analysts this week mention that Saudi Arabia has already committed to increasing production and exports in order to ease concerns arising out of the present conflict. Look, that's simply not true. What Saudi Arabia actually said was that if this conflict escalates in a way that threatens global oil supply and results in a runaway upside excursion in oil prices, then the kingdom would respond by increasing production and exports as much as possible to help stabilize the market. That's nowhere close to the same as saying that they already committed to increase production. To the contrary, we're almost back down to $80 Brent, the level Dr. Anas Al-Haji said he would expect OPEC Plus to defend. So if the market keeps selling off on what I think is excessive complacency, we should expect Saudi Arabia and OPEC to cut production, not to increase it. And quite frankly, I don't mind saying that I think Western traders are being unduly influenced by misleading propaganda. The Biden administration would have you believe that the Saudis and OPEC Plus are an evil price cartel that we should see as an enemy because it's thanks to them that we have such high gasoline prices. I couldn't possibly disagree more strongly. I applaud the Saudis for their commitment to restoring spare capacity in the global market, which is exactly what the world desperately needs right now, so that if one of the several formative wars that we have on the radar screen does take several million barrels of supply off the market suddenly, it will be possible to tap that spare capacity in order to avert a global oil price crisis that could exacerbate the underlying military conflicts even farther. So as far as I'm concerned, the Saudis are the grown-ups on the oil stage right now, and it's the Biden administration's reckless draining of the U.S. Strategic Petroleum Reserve, just as a serious global conflict was starting between Russia and Ukraine. Now that's what I think should be condemned as threatening both the economic and physical safety of the American people. OPEC Plus and Saudi Arabia are the heroes in this story, not the villains. They're working hard to restore spare capacity to the system in case we need it, which I think we eventually will.
Eric, on page 2, I have that crude oil futures chart for the December contract. And obviously, we've been in a deep correction over the last month as we put in those highs in the mid-90s and have been correcting down toward $80 here. To me, this is actually a very interesting moment. All of the highs of 2023 in the first half of the year were more or less established in the $80 area. So now, as we correct back, you can see the 200-day moving average lying there. This is an interesting area where one would think that oil would find support. And it'll be interesting to see whether a short-term viable bottom comes in here, especially if the whole market is temporarily going risk on. It might give an opportunity for crude oil to reverse. Will it break to new highs? Will it go to 100? Those are early speculations. But at this moment, it'll be interesting to see whether the short-term low comes here and whether we get to the mid to high 80s here in response to that. And moving on, though, to equities, what are you thinking here on the markets, Eric?
I think we're at a very important make or break moment for the S&P as we flirt with retaking the 200-day moving average. We've been in a very clear downtrend for the last several weeks, but as I've said before, the usual pattern when a war breaks out is that at first traders panic and they sell everything because a war broke out. Then they calm down, take a deep breath, and think it through. And then they remind themselves that wars are always inflationary and involve lots and lots of government spending, which usually brings about a full recovery in the stock market, led by defense stocks. I think that's probably what's happening now, and a solid move above 4,300 on the S&P would be the first confirmation. The next confirmation would be retaking the 100-day moving average at 44.31, and above that level, 46.12 is the next upside target. But the question is whether the recent weakness was war-related or just because the most anticipated recession of all time really is going to collapse demand. And if that's the case, this could just be a dead cat bounce off a badly oversold technical market. What happens here at the 200-day moving average should give the tell on the next leg.
Yeah, I want to comment on those moving averages in a second, but I want to get Nick into this conversation. Nick, on the S&P 500, what levels are you watching?
Spot price right now, Patrick, is approximately 42.40 on SPX. We have a call wall above at 4,300 and a put wall below at Friday's support area of 4,100. The implied move for the November 17th OPEX is plus minus 105 points. The upper expected move is 43.45, and the lower expected move is 41.35, just above that support area and that put wall. Key resistance right now is just above at 42.50, then 4,300, and key support is now at 4,200, then 41.50. As we discussed last week, I thought we'd see perhaps a dead cat bounce toward the 4,300 mark area, and we saw a pullback all the way down to 4,100, bounce off that pretty fast, and as we speak right now, we're almost at 4,300. So that's transpired. Apple has earnings tonight. Powell spoke yesterday, and he was pretty bullish overall on the economy. So that may pave the way for a late end-of-year rally, perhaps.
Nick, I like to look at a little bit bigger picture. When you look back to the October 2022 low, we had 1,000 S&P point rally into July. And what we really witnessed up to this point was about a 500 point pullback. So it's about a 50% retrace or give back of the previous rally in that bigger picture. And we were quite oversold, certainly by a lot of metrics. There was no shortage of technicians and other quant people out there talking about these very oversold conditions. 4,100 was a level that we were watching and talked about on the show numerous times in the weeks prior, and we're getting a bounce. But by no means am I ready to already, turn bullish just because we were oversold and the market reacts the other way. It is not enough for me to suddenly say, oh, now 4,600's on the table. I know this is certainly possible, but in my view, we have incredibly tight financial conditions, and the old adage is don't fight the Fed. I mean, we are now in a scenario where the Fed is pausing because they've already tightened the conditions, and that's not typically an environment where a new bull phase occurs. And so to me, 4,300 right around this area is a fib bounce. It'll be interesting to see whether or not the bulls can follow through this area, because if you look back to the August market rally and then subsequently the late September rally, each one of them was just under 200 S&P point bounces. They each lasted just under 2 weeks, and each time the market rolled over. And so I want to first see what happens now that we're bouncing. It looks very similar to rallies of the past, bounces of the past anyway, and we're going to see whether or not the market reacts here and fails. I think if the bulls continue to work a little bit on this and the dollar backs off, maybe we see 4,400 or something like that, but I'm not overly bullish beyond this bouncing a little bit higher. Nonetheless, let's move on to the NASDAQ. Obviously, Apple earnings is going to influence this, but at least what are the levels you're watching?
Spot price right now on Qs is 359 approximately. We have a call wall above at 380 and a put wall below at 345. Now, the implied move for the November 17th OPEX is plus minus 12 points. So the upper potential move would be 371, and the lower potential move would be 347. Key resistance right now is just above at 360, and key support is just below at 355. As you just mentioned on S&P, I see it kind of the same way a little bit in terms of, we had a significant decline over the last couple of weeks. I think the S&P and the NASDAQ were both down about 7% roughly, and now we've bounced about 4%. So again, short term, I do see a bit of a bounce toward around the 375, 380 mark perhaps on Qs. But that's where I'd be hesitant to add to longs. What I am looking at, however, is the small caps, which on the Russell IWM was trading near 160 and your lows. And now it's trading at around 167 or so. I'm more bullish on small caps simply because they've been so decimated and they're down over 20% from the highs. Again, a pair trade may make sense perhaps where you go short big tech and long small caps because, again, I do think small caps will outperform in the short term.
Nick, let's move on to page 6 where we have the volatility index. And while we did see a rise in volatility, I'm actually a bit surprised that we didn't sustain a period above 20 for a little bit longer. What is also really interesting is how quickly volatility has backfilled. I mean, we are back to the 16 handle on the VIX, and suddenly vol premiums are once again reasonably priced. And that happened very quickly. It'll be interesting to see whether or not we revisit the previous lows. I'm actually a bit of a seller because I think the summer lows were a period of very low realized volatility, and I don't think we're necessarily going back to that. So maybe this 15, 16 level might be the bottom end of the range. How do you interpret it?
So the VIX right now is at around 16, which denotes that we should have about 1% broad movements in the S&P daily. That's a top to bottom move. Again, it was surprising to see us pull back from that 20 level as Powell spoke. But as we see the markets rally back up and we see demand for out-of-the-money options decline, that's where you see the VIX go down. And right now, yesterday, for example, we saw a lot of volume on the short term, that being the 0 DTE call options. We haven't seen substantial call buying out of the money for longer dated options, which is what would drive the VIX a bit higher perhaps, as well as puts. So I think we're going to stay between 16 and 17 perhaps over the next couple of weeks. But after that November OPEX is what I'm going to look for to see if we pop back up toward 20 or if we die back down to 12-ish on a end of year rally. Now moving on to the US dollar index on page 7, what are your thoughts here?
Still in the consolidation range between 105 and 107, and as of today, we've been in that consolidation pattern for a full month now. I fear that this will resolve to the upside, and if it does, on a measured move basis, the next target appears to be at least 113. That could get ugly for risk assets, and I think it will happen if we get the big escalation in geopolitical risk that nobody other than me seems to be worried about. And frankly, since nobody other than me seems to be worried about it, that means they're not hedged for it either. And that means if that upside move does happen when nobody's hedged for it, it could accelerate very quickly.
Yeah, the dollar has certainly found a short-term high along this 107. It looked like it could potentially have broken out. The U.S. dollar yen was breaking out to a higher high, which I also have a chart on here. But now, obviously, after the Powell comments, the dollar backing off a little bit. I don't think it changes anything for the dollar. I mean, can we see a dollar gravitate back toward its 200-day moving average? We see 105, 104.50 as the euro bounces a little bit. That can happen, but I don't think that changes my overall view of what is going to happen to the dollar. I think all buy-on dips can occur on that kind of a pullback, and inevitably the dollar is probably destined for a trip back to 2022 levels up higher, and that's currently where at least I stand on this. So it'll be interesting to see how deep this pullback is before the buy-on dip emerges.
Now moving on to page 8, we have the gold futures chart. Eric, what are your thoughts here?
This week saw 3 red candles in a row on the daily chart, and that was for the first time since the market bottomed at 1825 over a month ago. That says to me that the gold market is breathing a sigh of relief, one that I think is misplaced, because they think the Israel-Hamas conflict is going to de-escalate rather than escalate from here. So gold is reflecting what we're already seeing in the crude oil market. Nobody but Eric is worried about this thing escalating substantially from here. If there really is no escalation and Israel wraps up its military operations without any more escalation, then at least a 50% retrace back down to 1900 or so is entirely plausible. But so far, all we've seen is a textbook pullback back down to the 13-day moving average, the lowest of the three short-term moving averages. And that unto itself is nothing but a healthy correction in a bull trend. But a daily close below 1980 could lead to a very rapid retracement back down to 1940 or so, especially if war risk is abating. Personally, I'm not taking profits, and I'm holding my gold longs because I still think the risk is much higher than others perceive. But for now, I seem to be alone in that view, which means I'm preparing myself for what could be a very significant pullback in gold before the bull market resumes.
Well, Eric, for me, first of all, what was rather surprising was the fact that gold rallied while the U.S. dollar was rallying throughout the past month. And now with the U.S. dollars pulling back, the question is, will that act as a tailwind? Obviously, geopolitics are a factor. Obviously, rates are a factor. But overall, the bigger move in gold is likely to happen, in my mind, during an easing cycle. And so to me, what would be the most interesting thing would be if gold managed to stay up here in the 2000s for an extended period of time, go up to 2050, pull back to 2000, trade in that range, establish a new higher level that is sustaining above the 200-day moving average. That could really set up for a very bullish 2024. It'll be really interesting to see how the bulls can defend this during a consolidation phase. Nonetheless, I want to move on to a few other charts. On page 9, I have the U.S. 30-year government bonds. We showed the 2-year last week, and it was interesting that Stanley Druckenmiller was talking about taking big positions in the 2-year. But the 30-year as well is bouncing. And while it's hard to make an argument that we're going to see much lower yields and a huge rip higher without there being, let's say, a huge recession or something of that sort. But if you look back through the November 2022 through to December, January of 2023, we had bonds bounce from a very oversold condition and gravitate back to the 200-day moving average. It'll be really interesting to see whether we're establishing a short-term low and whether we just simply get a reactionary rally from just a very oversold condition. This could alleviate a lot of the stresses on the market as rates back off, which could feed the risk-on impulse a little bit on the interim. It'll be interesting to see whether that short-term bottom is there. And finally, on page 10, I have the U.S. dollar yen. We already talked about the U.S. dollar, but what was interesting here is the U.S. dollar yen popped above that 150 overhead resistance on the Bank of Japan and approached 152, which was a measured move target on the upside that I was talking about with members for a while. The interesting thing will be, will the bulls be able to hold that U.S. dollar above 150? One of the things that would mark some sort of a short-term top and a mean reverting correction would be if we dropped back below 150 and stayed there for a couple days or even a week, because that could open the window for a pullback to 148 to 146, which would contribute to the dollar index heading back to 105 or 104.50. Will we see this U.S. dollar yen putting in a little pop and drop along this high is certainly something I think all listeners should be watching for.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.